My name is Wang, and I will be moderating today's discussion. I will be joined by Waranch of Spearmint Energy, Eileen Howe of Hecate Grid, and Alden Phinney of GridBeyond. For the next 45 minutes, we'll hear from these experts about the latest throughout the entire energy storage value chain, from project development to operations to trading. While I ask our panelists some questions, I would also encourage you, the participants, to submit questions as well in the dashboard on the screen you are seeing right now. There's also an option for you to upvote questions if you see something that really resonates with you. And we'll have some time for Q&A at the end, but I will also try my best to incorporate your questions as the discussion goes on. So with that, let's get started. So I am an energy analyst by trade, and I've been focusing on publicly available grid data in markets with a ton of renewable penetration, such as Ireland, California, and Texas. And the growth of grid-scale storage has been really impressive in CAISO and ERCOT. For example, in 2023, the record discharge of battery we have seen so far happened in September, and that was about 5.2 gigawatt. And that is higher than about 2 gigawatt higher than the 2022 record in CAISO, which is about 3.4. So, and that's CAISO. So in ERCOT at the same time, the record we have seen so far this year also happened in September. It was about 2.2 gigawatt at one point. Even though it sounds like it's lower than CAISO, but if you think about what was happening in January, it was only less than 1 gigawatt at one point. So going from less than 1 gigawatt of discharge in January all the way to September to 2.2 gigawatt is still a very impressive trajectory. And at the same time, we're also seeing still seeing a fair amount of renewable curtailment. For example, in ERCOT, in January, the wind curtailment was about 7%, and solar reached about 16%. And if you look at regional differences, due to transmission capacity constraints, we actually see sometimes solar curtailment rate reaching as high as more than 60% on some days in January. So even though the growth of storage has been really impressive, these indicators like renewable curtailment still shows that there is a huge need and potential for more batteries to come online and to work in these markets. So with all these market data points I just kind of rattled off in mind, Eileen, if you don't mind starting us off here, could you tell us a little bit about your existing portfolio and also your strategy in terms of optimally siting energy storage projects, both in the short run and in the long run? Thank you.
Sure, thanks, Faye. Well, they really queued us up nicely, so I appreciate that. So when we think about our portfolio, we have one operating asset in Santa Ana, California, and 3 under construction. And our development strategy has been optimal with given 3 key inputs. So these inputs usually are locational studies, transmission analysis, and regulatory policy. There's a number of other things, but I'll focus on those 3. So the locational studies will provide us information about local prices and volatility for both the near and long-term insights on the predicted revenues for that specific location. And then we would layer in the transmission capability analysis, which is often done with a long-run view and understanding of the persistence for the need for the storage at a particular location. Following that up and participating in regulatory proceedings is so important, which really informs operations in the short term and guides the development stream in the long term. So when we think about how that works for our operating asset, for example, in California, is they might be changing the energy storage enhancement initiatives and how we think about bidding into the market, we have to layer in all of those different policies in real time for real-time bidding. And then in the longer term, when we think about other things like transmission constraints and reform, interconnection reform, those are all things that go into that development decision.
Great, fantastic. Andrew, does what Eileen just described resonate with your approaches as well, both short-term and long-term?
Yeah, absolutely. I mean, we start off with several different screens, right? Like everyone, we have a funnel. We focus heavily on congestion, forecasting where congestion's going, if you will. It's getting to where the puck is going to be, not where the puck is. And so that means doing a lot of forward-looking analysis of grid models. We really identify what we believe is the top 1, 2, or 3% of all the nodes in a given region where we want to be. And we feel that those top few percent have a significantly higher revenue potential than the rest. We look at injection withdrawal capabilities. We're highly focused on putting batteries where they should be. At a top level, that's either A, near the generation and the pain points. So our first battery revolution, 150 megawatt, 2-hour facility in West Texas, is physically adjacent to both solar and wind. And so it can immediately help reduce lost generation. Separately, most of our other projects are near load, where it can help more on grid resiliency and keeping the lights on. And so we're focused on both solving things from an electrical point of view and from a price point of view.
Yeah, that's a really good point in terms of it's both a question about getting closer to renewables to absorb that intermittency, and also getting close to load to take advantage of that flexibility as well. Alden, I know you're not a storage developer, but as a product and solution provider for the developers, what types of data and tools do you have to assess project feasibility at an early stage?
Definitely. So we focus on revenue analyses for storage projects from an early stage basis. We use a combination of production cost modeling and a data-driven approach based around machine learning to identify what potential price outturns could be at a specific node, either in ERCOT, CAISO, or some of the other open markets around the country. And then we work with storage developers to analyze what the long-term merchant revenues of a project could be at that node. So I think we have a variety of toolkits that our team uses internally. We have a software toolkit that we've built out that helps with the modeling, and then we run that through various, production cost models to enhance that once we get down to a nodal down selection. But I think that software and really the advent of machine learning has been a real boon for being able to run these sensitivity analyses very quickly. I think that's what we've seen is often we're working with storage developers who are looking to identify a go, no-go decision on a specific asset, and having the ability to run multiple sensitivities versus a more deterministic price forecast has been valuable for our clients and valuable for us as we look at what the optimal siting position is for storage assets early in the project life cycle.
Yeah, great. And in terms of, I know there are a lot of projects right now kind of stuck in the construction phase. What are some main challenges they face before they could be completed? Andrew, do you mind starting us off with that one?
Sure. I think I'm muted.
Oh, you're good. We can hear you.
There you go. So there's a lot of, I guess you would say, bottlenecks in the process, all the way from procurement to completion. On the procurement side, there actually is a fair number of batteries available today. Over the last few months and quarters, we've seen a number of new facilities opened. We were in China last week, and we toured a number of facilities that were 10 to 20 gigs in annual production capability, which were running well under their limits, waiting on orders. And so there's really no shortage today of batteries, and you can even get deliveries in 6 to 9 months from most of the large players. The real bottlenecks are one, interconnection queues, and 2, large substation equipment. I think 3, we could talk about it another time, will be shipping delays through the Panama Canal. But right now, I think the longest delay, of course, remains interconnect. In ERCOT, that's several years. In MISO, SPP, PJM, that could be 5 to 7 years. And so first and foremost is going through the process. Once you go through the process, you then have to procure large substation equipment and then install that. the procurement times for large substation equipment can be 2 years at the top end, maybe even 3 years in some extreme places. So getting orders in for large substation, medium voltage transformers, and similar technologies, the world is all buying them simultaneously, and they're all slightly customized. So there's not a big inventory of them. So if you are using, if you're doing solar or wind or gas-fired generation around the world, you need a transformer. And so the demand is quite high everywhere. So you have the interconnect timeline, you have purchasing the equipment, and that then you have installing the equipment, which is can be several months to wait for the utility crew or a third party crew to actually have time to install. So there's a number of bottlenecks. Thankfully, I don't think the bottlenecks today are in the capital side, the tax equity side. I think there's interest from finance and investment folks. It's really just you need more people and nuts and bolts, and you're trying to grow the space too quickly, sort of asymmetrically.
I see. Yeah. So one of the questions actually coming through from Q&A is, would you mind describing kind of the types of storage you're deploying? Is it lithium ion? Is it other types that you're currently working on? Oh, Andrew, I think you're on mute again.
Sorry. We are large scale lithium ion. Our first battery, as I said, is 150 megawatts, 2-hour batteries. We chose lithium ion for 2 or 3 reasons. One, the cost is low, the technology is well understood. If you look at the world as a whole, there are 31 gigafactories under construction, ranging from 1 gigawatt to the largest we've seen is 30 gigawatts under construction. All of them are LFP. All of them, well, almost all of them are LFP. Some are NMC, but really all of them are lithium based. And there is a belief amongst the large scale investors of the world that it's cheap, it's easy, it's bankable, and as such, it is how the world will build batteries for the next 5 to 7 years. Now, beyond that, there's a number of promising technologies which could take over, but there's so many in the laboratories. I believe last year in 2022, the first half of the year, new battery technology was the number one space invested in by VCs. And that's great. And that's all going to lead to new technologies that are perhaps commercial in 7 to 10 years, but not in the next 5 to 7 years. So we feel firmly in our belief that at least through the end of the decade, lithium is the preferred option.
Great. Eileen, does that resonate with what you were saying as well?
Yeah, absolutely. I think Andrew's right. And as we've talked to, different even scientists out at Argonne Labs and other labs, they say the same thing. And there a lot of these things that are in the lab now are really ripe for huge opportunity. And I think it's going to happen. And especially as we look at longer duration type batteries and other use cases for battery storage, we may need a different chemistry, but right now we're seeing the same thing that Andrew's seeing, and that's what we're looking at for most of our projects. And I also would agree with him on what we see on the supply side. Certainly there was disruptions around COVID, and that's really diminished now. And to his point, I don't think we're going to have trouble procuring the batteries, but there is the long lead equipment, the medium voltage transformers that he mentioned. I think having an experienced development and EPC team really helps to navigate through each of those things, and as well as the permitting and construction and commissioning. And once you get into that phase, you're well past making those decisions of what type of storage are we putting in the ground. But I think going forward, there will be a lot of opportunities for different types of chemistries. I just don't see that happening in the next 5 years.
Got it. And one other question in terms of early stage of development is that have any of the storage projects faced any local oppositions? Because we've seen this definitely for a lot of wind projects in the past and ongoing. When you talk about different factors that impact early development stages. Is that something you have seen? Is that a factor for storage developers to be concerned about? Eileen, would you mind sharing some of that?
I can start with that. Certainly, we want to be a really good partner to our neighbors, as we're developing these storage projects, and we work with industry leaders and permitting experts, fire safety experts, to make sure that we are really going to be a good neighbor and we understand all the regulations in each area, and really work through each decision point with the communities, which you must do to be a good partner and a good neighbor. And I think that our permitting challenges going forward, but I think they're all solvable. And that's what we're seeing. We're seeing when meeting with people and working through the issues of concern, it makes it more of a conversation. And people are excited about storage. I mean, having a storage facility provides so much more reliability. When you think about an outage from weatherization impacts or anything else, whether that be in Texas or a high wind event in California, storage will help that reliability issue. And the communities absolutely appreciate that.
Yeah. Andrew, what about you?
So completely agree. I think the number one benefit of storage versus solar and wind, however, is that our facility, which is one of the largest batteries in the world, is on 9 acres, right? And so the actual footprint is quite small. Given the increase in battery density, you could have a 10 megawatt, 20 megawatt hour battery on less than a quarter of an acre of land or a small parking lot. And so I think by the end of next year, really in only 2 or 3 acres, you'll be able to have a 100 megawatt battery. And so that's easy for concealment with trees, buildings, fencing. And so it's not an eyesore. It's quite small and it can easily be hidden away. In fact, a lot of our projects are being built on scrap or unusable acreage that solar and wind could never use. So that's one thing. It's very small. 2, it's very quiet relative to solar and wind. And so that's not as offensive. As Eileen mentioned, it is quite good for reliability and really grid resiliency locally. And finally, and probably most importantly, it is a major taxpayer. Fire, highway, school, county. I mean, some of our projects pay well in excess of 7 figures a year in taxes for something that may only be 5 acres. And to have a 5-acre taxpayer of over $1 million a year is quite helpful to all communities.
Right. Yeah, just to follow up, I'm seeing from the audience Q&A about whether the size of the projects you're trying to develop, does that impact the weight for interconnection queues? Because it seems like you're working on kind of a larger scale projects. Actually, Alden, do you have any insights into this, since you see kind of all kinds of projects being developed? Does smaller size project get operated faster?
Sure, and a lot of it will depend on jurisdiction and the regulations relevant to the siting of the project. But a popular strategy that we've seen in ERCOT for a few years now, for example, has been to size batteries at just shy of 10 megawatts, so the 9.9s folks like to talk about, because there is a shorter and less onerous process to get those connected into the grid. I think winds have shifted a little bit, now, and we're seeing a lot of activity sort of at utility scale, and folks liking to deploy hundreds of megawatts at a specific site just to achieve certain economies of scale. But there is definitely a time advantage to finding opportunities that may allow you to interconnect or achieve COD faster with this project. Front of the meter, more behind the meter.
I would just add one point to that, Aiden, that we've seen a couple of jurisdictions where there are hundreds of those in the queue. And so you end up having as long of a waiting period as the larger ones. Because they're smaller, you have a lot of very small developers that can submit them. And so you might end up with 100 ahead of you in line, and so it's a bit of a time savings, but maybe not as much as expected.
Is the one you're referring to in which market is that?
In Texas.
Oh, okay, great, good to know. Great. So so while we're on this topic about how long the wait is, I will also want to include a discussion on kind of financing and revenue stream part of the discussion. One of the audience questions actually asked about how important are power purchasing agreements for storage projects, and I think it's fair to say that a lot of renewable and storage developers probably are inclined to avoid merchant risk. So, but I think both developers here today are willing to take on that risk in terms of your offerings. Actually, I'm going to start with Alden for this question, if that's okay. So what are which revenue streams are in saturation, and what are some key mechanisms and regulatory changes that you feel like that's needed to expand existing revenue streams?
Well, I think, especially in the markets that we're talking about primarily today in Texas and California, there's obviously very different constructs around how storage is compensated and how energy resources generally are compensated. Texas, the ERCOT market is relatively unique in that there is not a capacity or resource adequacy construct currently, we should say, but that the assets have to exploit, intraday wholesale arbitrage opportunities as well as ancillary services to secure revenues in the open market. Whereas, developing in a place like CAISO or PJM or most other grids worldwide, frankly, there is a capacity market that'll help to provide benefits to a storage project or other sort of generally firm resource that can provide capacity during a scarcity event. So, just to name that ERCOT is a relatively unique market. Because there is no capacity market, though, the volatility that we see in intraday pricing, primarily real-time pricing, but occasionally day ahead as well, presents real opportunities, and I think has driven a lot of the development interest in ERCOT is that sort of volatility introduced by solar and wind primarily. However, ERCOT, a lot of the development that we've seen get financed over the past couple of years has been relying on the ancillary services markets for a sizable chunk of their revenue streams. I think last year, 2022, it was something like 96, 97% of operational storage assets in ERCOT's revenue was received from the ancillary services markets, predominantly RRS at the time, but also regulation up, regulation down. And I think ERCOT is really trying to figure out where some of this money comes from and should go in the service of ensuring a reliable grid. We've seen them introduce the ECRS, ancillary services product, earlier this year, which has had very good pricing for the first 6 or 7 months that it's been in operation here. But I think moving forward, ERCOT is considering capacity-like constructs, should we say? Maybe not a full capacity market, but there's definitely a bit of a market evaluation underway in ERCOT. One of the primary trends I think we've all seen in the space is concern with the saturation of these ancillary services markets as well in ERCOT especially, but other markets to follow. Saturation referring to the fact that we are forecasting hundreds of megawatts, gigawatts, tens of gigawatts to come online in the next couple of years in terms of battery storage capacity. And they were all going to be, to some extent, chasing the same shallow ancillary services markets in ERCOT, which don't have the same amount of volume in them as wholesale markets. So we expect pricing in all of the ancillaries realistically to come down in ERCOT over the next couple of years. I think that will present very real challenges for financing storage projects. But with that, there's sort of an interplay between the amount of storage coming online and the amount of intermittent solar and wind coming online and the retirement of fossil gensets. And what that means for overall ancillary services procured and overall ancillary services fulfilled by storage. So there's a few dynamics that we're tracking going on in the space, but I think the sort of saturation of ancillary services is something that we expect to impact storage projects within the next year or two, pretty fundamentally in ERCOT.
Got it. Andrew, you're already on mute yourself, so go ahead.
So one, we think that generally because of the problems with physical interconnect delays, substation equipment, transportation delays, and such, that this is ancillaries are higher for longer. And that's just because everything is the works are gummed up everywhere. And so you end up with a dozen projects wanting to move faster that just take longer. And so I don't disagree that, you could have overbuild, but the rate of change of overbuild of solar, of wind, and storage is highly dependent on where they are in the queue and where they are in the TDSP's build out. And what's happening in Texas will clearly happen throughout the world. But to really get back to your question, we have two sides of our business. One is an energy services business, which is all about risk transferring. We generally come from the energy trading community. I've been an energy trader for over 25 years. And there are plenty of firms and investors who want that risk on their books. And so we like transferring risk from the asset and the asset developer to the energy services side because they want that risk for profit. And so the infrastructure investor gets a more reoccurring, guaranteed annual revenue stream. And then the trading and marketing side, they can go out, find ways to hedge and monetize that risk. So we're all about risk transferring, and our energy services side of our business offers tolls and offtakes on storage to not only our batteries, but to the rest of the street as well.
I see. Yeah, Eileen, I know we've been talking a lot about ERCOT, and you have more experience in CAISO. So we'd love to hear kind of what your experience has been like as well.
Right. Well, I think what we talked about earlier is some of the curtailment issues. And when you see that amount of curtailment, whether that be in California or Texas, that does provide the opportunity for storage to come in and take the other side. So we're charging at much lower prices, right? And as we're talking about discharging into either ancillaries or energy markets, that's very important. But remember, the batteries are going two ways. So the importance of being able to charge from renewables is very critical to the revenue streams. The other piece to the revenue streams that I wanted to talk about a little bit was about the opportunities energy storage will have across the West and in the Midwest as well, as we have legacy coal freeing up capacity. So whether that be for a PPA or even for transmission, you're going to see that change as well coming up. So to Andrew's point, there's so much more renewable space, more renewables to take care of coming online. And storage has a long room to grow. And I would agree with him that pushes out the ancillary market saturation point a little further.
And one of the audience
too.
Sorry?
Oh, I think that's true in both California and Texas.
Got it. Yeah, and one of the questions from the audience is California is changing the approach to resource adequacy to change that into like a 24-hour slice of the day approach. Does that impact any of the revenue streams and how you approach financing? Does that have any impact?
Is that question for me or?
Yes, for you. Yeah.
Okay, sure. Typically we work with a number of industry groups to really understand what's happening. And as we're bidding in and thinking about what procurement looks like over the next, or offtake looks like over the next few years, we were very concerned about that early on and not so much now. I think the Slice a Day program with respect to a 4-hour system is going to work fine for battery storage. A 4-hour duration system is going to achieve what California needs it to achieve for their market for RA, for the resource adequacy contracts. California has done a lot of work on that and is, I would say, very good at getting feedback from industry participants and understanding not only how that's going to impact their offtake agreements, but how each of the load-serving entities will integrate that. And we've been actively involved in those conversations and participate with the CPUC and CAISO on all of those reliability needs. So I think that and all the other energy storage enhancements that California continues to improve on is going to help the market for battery storage.
Great. So we talked about kind of early stage development, talk a little bit about revenue streams and financing structure. And I know that both Eileen and Andrew, your companies also take on analytics and trading, and also trading storage, particularly usually is on an hourly or even sub-hourly basis. So what are some technology requirements and analytics that's really unique to storage in contrast to maybe more traditional commodities or even power markets? Alden, I'm actually starting with you since you are, again, the software approach.
Thanks, Faye. And yeah, as you mentioned, we don't have assets that we own, but we do operate assets for storage IPPs, and we also have a trading software that we built, specifically to take on this challenge. And I'll go quickly because I'm really curious to hear Andrew and Eileen's take on this. But what we found be necessary for storage more so maybe than traditional trading approaches has been the sub-hourly constructs that you mentioned. Making sure that you're able to take advantage of maybe smaller opportunities throughout the hour, throughout the day, and to do that, you need a high resolution and high refresh rate of the data that's coming into the platform. Storage also, especially in markets like ERCOT, presents a multi-dimensional, almost three-dimensional arbitrage optimization problem. As Eileen referenced, you have to charge the battery in order to discharge the battery into the ancillary services or the wholesale market. So in ERCOT, you're optimizing, both in terms of hours of charge and discharge. And with that, what your associated costs are going to be in the wholesale market, where you can discharge either into the real-time day ahead or, any of the ancillary services markets. That's sort of a second dimension. Then if you're looking at a portfolio of batteries that, one provider is operating, there may be as well, the optimization of the ancillary services awards across different assets within the portfolio so that you leave the most advantageous positions in the real-time market for a specific asset to take while fulfilling the ancillary services with an asset that may not have as much real-time upside. So it's a very complicated, issue that we spent a lot of time thinking about, but really curious as to Eileen, Andrew, and how you all are thinking about this problem.
Yeah, Eileen, you want to follow up with Alden's comment?
Sure. Alden, for as much as he was being humble and saying he wanted to turn it over to us, he explained the problem very well. I think when you're looking at it as a storage owner and operator, you're looking at things a little differently than other, what you might think of as a regular or a wind, like a wind plant, for example. An asset manager for a wind asset would have a concern when participating in the day ahead market that generation may not be available and there'll be short power in the market, right? And so for a storage participant, you don't really think about that day ahead risk in the same way. And we can actively optimize our state of charge and manage the risks in the day ahead and in the real-time market, as Alden mentioned, sub-hourly. We do this with continual model integration and optimization each day for a series number of days looking forward and intraday as well. So we have built internal forecasts, we use vendor forecasts, and we use them to direct our dispatch operations through a proprietary dispatch algorithm. So that is a lot of words, and it really just means that we use a lot of data-driven analysis each day to be to understand our bidding strategy better and to have a feedback loop with our bidding throughout the day and in real time. And in California, it's an integrated forward market. So you've got day ahead, then you have 15-minute markets, and you have real-time markets, and each of that has different data that may impact that particular time slice. And Texas will have its own challenges as well. It's a different set of data.
Yeah, and I'll punt it over to Andrew, since I understand you have a lot of experience in power trading, and I think your company also has people who are more experienced with more traditional commodities. And how are you approaching the storage trading?
So a lot of the existing software and data a lot of the other tools that power traders use when evaluating real-time hourly prices doesn't do well sub-hourly. And if you look at many of the existing stack models, a lot of the existing tools for gas-fired generation and others, they really weren't ever designed for modeling 15 minutes, 5 minutes, 1 minute. Some of the actual load following things like AGC and such have been doing it for years, but really less on a model side, more in actual minute to minute dispatch. And so all of the existing fossil related dispatch models, they sort of don't work great here. And even the existing storage facilities, I used to work at a firm that had very large pump hydro, they just never modeled it granularly enough. And again, today, even the off the shelf stack models barely can do 15 minutes, let alone 15 or 5. So it is a different problem. It's the reason you see so many folks trying to do it now, is because it's actually something that hasn't been solved yet. There's a whole bunch of strategies. A lot of folks use stack modeling. Some use weather volatility. Some use price volatility. I spoke to earlier today a bunch of folks that won't even use weather volatility. They'll only use load volatility. And so there's certainly a number of ways to attack this problem. We're far from the end of finding an established solution. There are some that are better. We've evaluated a lot of third-party products. I think similar to what Eileen began with, we will end the day with a majority of internal, but continue to use external as well. I will say that the majority of the software does not think holistically enough about positions, meaning we are a green entity. We will not trade thermal fuels. We will not trade oil, gas, or coal. Many others will. And I think that there are significant opportunities to combine storage analytics with traditional thermal production that have not been fully identified yet.
Oh, interesting. Okay. Is that something like Alden or Eileen you have seen as well? Just this kind of storage being on its own instead of being more holistically modeled?
Just a quick thought on it. I think that storage in some ways is still so much in its nascence in terms of utility scale and actual IPPs coming out. So I don't think we've seen a solution that has brought the two together in a really cohesive way yet. I know there's some interesting work underway in CAISO about co-locating storage facilities with existing gas peaker plants, and that's less of a position sort of management, but more of the physical asset co-location that I think are going to be interesting. But just to follow up on one thing that Andrew said around the sort of the amount of data that's being processed and stack models, and I think that something that GridBeyond has found necessary to successful modeling of the sub-hourly markets has been the application of machine learning. And I think there's too much hype around AI, but this is actually a very good application of machine learning and artificial intelligence to model these fast-moving markets and be able to ingest large quantities of data into a model that spits out a result in a time-sensitive fashion.
Eileen, when you say machine learning, is it kind of supervised learning, kind of or reinforcement learning for like optimization? Just getting one layer under like specific types of machine learning that's actually being deployed here.
Definitely. So it is supervised. For each of our models are supervised. The actual structure that we use is a ensemble approach that leverages a random forest technique to actually identify multiple models for each individual problem that we're trying to solve. And these will happen at the sort of price forecasting layer, and then again at the optimization layer before being configured for an individual asset. The primary input is going to be the price forecast, though, and that's where we spend a lot of our time, is looking at how do we use data science toolkits, including machine learning, but not exclusively, to model those. And what we found is having this random forest approach really allows us to leverage multiple models. 5 is sort of the standard that we use to have both a winner and a challenger each day, and then 3 other models that are in contention. So we're really leveraging a huge amount of data and then looking at the performance on sort of shorter time frames of the past few days to see which model helps to best explain market behavior for those time frames.
Great. Yeah, we don't have a ton of time left, and I really want to get to this last question on my end. Eileen, I would like to start with you for this one. I know we talked a lot about CAISO and ERCOT today. What are some other markets in the U.S. That you were excited about their storage potential?
I think right now we've looked a lot at the Northeast, and then we started focusing again back on the West when we understood what was really happening in the Western states. And you see so much opportunity there. We've talked a little bit about that earlier when we talked about legacy coal retirements and opening up the capacity along transmission lines, providing additional offtake response opportunities. And we see the storage procurement goals for several of the utilities there: Northwestern Energy, Pacific Core, Public Services of New Mexico, Nevada Energy, to name a few. Each of these have procurement goals coming up in the next few years for energy storage specifically, and we're starting to see that procurement. And when you start seeing the need and the demand for storage, you know that storage builders are coming, and so certainly, I think out west, there's also the initiatives there to be a part of an RTO, whether some of the utilities move to SPP or to CAISO or a Western RTO. A lot of that is information. But when you start seeing some more structure around those markets, we can understand better how to participate in them. And certainly, our team of developers are actively participating in those types of discussions and decision points out in the West. I think there will be a lot of opportunities too in the Midwest and in the Northeast. We have to see too how capacity markets evolve a little bit more towards a storage favorable portfolio. And I think there will still be growth in Texas. The demand growth is high, and there are some favorable market conditions still in Texas as we see different volatile weather patterns and load growth, et cetera. A lot of pockets of demand still exist in Texas that have not been really have had constraints that are unresolved. And I think we talked about it a little earlier when Andrew was speaking. He said, you can put a battery storage plant in a very small footprint. Well, that eliminates the need for some of the long run transmission lines coming into a load pocket if you can have a storage asset there. And so we're starting to see some of that too: smaller footprint, smaller project sites that may work well for a tight load center. So population dense areas too that are underserved from storage right now, like the Western markets. I think those are probably the key points that I would hit there. And then I guess that pretty much covers the United States. We probably didn't talk about some of the other load centers aside from those in Texas that are growing. But I think too, as the economy recovers a little bit more, we'll start seeing more demand out in the Northeast.
Yeah, Andrew, anything to add? Expand it?
Yeah, I'll take it in a little bit of a different direction. We look very heavily at state-specific policies, and so Massachusetts is at the forefront with their Clean Peak program. They're certainly going to get a lot of interest with that. Just last week, Michigan, MISO Michigan put out a sort of mandate for a very large storage portfolio. And so that clearly will, vault as expected, but vault Michigan to the top of the charts very, very soon. Now, the counter argument, of course, is New York ISO. New York ISO has been talking about subsidies through NYSERDA, mandates from the governor for 4 or 5 years, all to the benefit of storage developers. But more recently, we're seeing a little bit of cold water thrown on that idea as both City of New York City and statewide deal with fire issues and local opposition. So state by state is good opportunity and risk. But I do think that Massachusetts, Michigan are clearly two of the top growth states in the next couple of years.
Got it. Alden, want to run us out here?
Sure, and we have a somewhat of a unique perspective, not actually building the assets ourselves and looking for those contracted revenue streams that I think are really important to storage developers. You know, as a market services provider, what we really look for is where the optimization opportunity is greatest. And so, you know, Texas is going to remain a focus for us, CAISO as well, just based on the, you know, sort of volume deployed in market to date. And I agree, you know, broadly with what Eileen and Andrew have said here. But I think the other market that's very much of interest to us is SPP, the Southern Power Pool, just because of the volatility introduced by wind, and especially in some of the areas closest to ERCOT. So we're tracking sort of intraday volatility and you know, penetration of renewables as really helping to identify where there are great opportunities to add value through optimization for our services.
Fantastic. All right. I think that's all the time we have today. So thank you to Eileen, Andrew, and Alden for sharing your insights. And thank you to GridBeyond for sponsoring this event, and also Canary Media for hosting it. And last but not least, thank you to everyone who has been listening in and also submitting questions. I think I included some, but not all of them. But thank you so much for participating and listening in. And we'll say our goodbyes here, and hope you have a great day. And thank you so much.